G'day and kia ora everyone. My name is Sanjeev and welcome to the Engineered Investments channel. At the end of this video, you would have gained objective insights into Cochlear, a healthcare listed company on the Australian Stock Exchange. Looking at the establishment metrics, Cochlear was established in 1981 or 40 years ago. It was founded by Professor Graham Clark when he and a small team developed an implantable hearing device that could detect and convert speech into an electrical signal that allowed people to hear, known as the cochlear implant. Here's a fun fact. According to the website, it was due to Professor Graham Clark seeing his deaf father struggling through life that ignited his decades-long research to bring hearing to people. Headquartered out of Sydney, today Cochlear manufacture and develop a range of electronic hearing devices specific for the type of hearing impairment. In addition, develop software that allows surgeons to safely fit and check for operability. They employ 4,000 people in 30 countries across Europe, North and South America, Asia, and of course Australia and New Zealand. They currently rank 34 out of the 2,200 plus companies on the Australian Stock Exchange. Looking at the front metrics, dividends have been paid continuously over the last 5 years, with the 2021 total dividends at $2.55, down by 80 cents per share from the previous year. The share price has grown by 91% over the last 5 years. If you had purchased shares in September 2016 for $123.12, as of August 2021, your share price would have increased by this percentage to $237.04. The 2021 revenues increased from the previous year by $177 million to $1.498 billion. Cochlear outlined this increase was underpinned by a combination of increased market share, new market products, and rescheduling of surgeries from COVID-19 shutdowns. Their cochlear implant units and acoustic products, as well as the service businesses, had all increased sales revenues by 19 to 22%, contributing to the overall increase in business. The company has provided a positive outlook for financial year 2022 through its clear growth strategies into unmet and addressable clinical needs that require cochlear and acoustic implants. In simple terms, they have the technology, reach, and bank balance to capture new business. The earnings before interest and tax increased by $75.5 million to $328.6 million. The profits before tax landed in at $320.2 million, an increase of $76 million from the previous year, which is very close to their 2019 pre-tax profits. The company has forecasted revenues is expected to be back on track when the surgeries are in full swing again, which will naturally increase demand in their implant products. Looking at the shareholder metrics, the return on equity ratio has increased to 13.8%, a negligible increase from the previous year, indicating whilst healthy profits are being maintained from the assets owned, there was still a flatline improvement. The debt to equity ratio has remained significantly tucked under 40%, a value we use as a rule of thumb for manufacturing type healthcare companies to ensure shareholders' equity is not likely to be impacted if the debt repayments were to drift upwards. The earnings before interest and tax margin, or EBIT, has increased to 21.9%, indicating profitability has improved when comparing pre and post tax profits. The gross margin decreased by 2% to 73%, the company mentioning that half of the decrease was related to the stronger Australian dollar. In saying this, a gross margin over 45% for this type of business is extremely good indeed. Profit after tax, or take-home pay, came in at $326.5 million. However, this figure was in addition to the $90 million legal rebate, a hangover from the legal battle in the US, which they won after an appeal. This same legal battle had contributed to the negative profit after tax in 2020. along with implant surgeries being postponed due to shutdowns. So, what's the outlook? Put simply, the COVID situation directly impacted the business, as Cochlear's technologies requires surgical intervention. So, as the clinics closed and opened throughout the year, the business bunny hopped along with it. Overall, the business slowed during this type of global market disturbance. And saying this, the economies are opening back up, and the company has effectively picked up where it left off. They're also building a new manufacturing facility in China to expand into new markets. In addition, the company continues to reinvest at least 10% of sales revenues into R&D that has allowed them to remain relevant and ahead of the game in product quality and capability, which they leverage to maintain their number one position in cochlear implants globally, where they currently hold 60% market share. In summary, dividends have been continuously paid over the last 5 years, including in 2020, where they made a profit after tax loss. The front metrics are good, but not fully recovered, with a $117 million increase in revenues from the previous year and a near recovery of pre-tax profits seen in a more stable when compared to a more stable 2019. The shareholder metrics are suggesting excellent profits are being extracted using shareholder equity, in addition to ensuring a near recovered take home pay, which is expected to revert to normal in the midterm. These characteristics typically signal a high potential for stock investment. This brings me to the end of the video. Please do like and subscribe. Thank you for watching. See you next time. Ka kite ano.